All right, welcome back to The Explainer. I'm your host, and today we're putting on our industrial energy expert hats. Look, if you're a facility manager or an energy engineer, you already know the drill, right? You've got these massive, ambitious sustainability targets coming down from corporate, a huge facility that's practically hemorrhaging energy, and a CFO who demands airtight, bulletproof financial justification for every single dollar you ask for. So picture this. You're sitting there with a backlog of 20 incredible projects on your desk. I'm talking a massive solar array plan, a full facility LED retrofit, maybe a $250,000 chiller upgrade, and a shiny new boiler system. But then your CFO severely limits your capital expenditure. Your CAPEX is gutted. So you've got 20 great projects, but you can only fund, say, 3. Do you panic? Absolutely not. Today, we're going to build a bulletproof framework to triage this backlog and select the absolute best projects for your facility. Okay, let's dive right into our roadmap for today. We're going to shift entirely out of panic mode and into a proven system. We'll hit the core problem of prioritization, walk through a highly practical assessment method, break down 3 key calculations your CFO actually cares about, look at how to avoid some really costly mistakes, and wrap it all up with a field checklist you can use today. Part 1, the problem with prioritization, funding the backlog. So you're caught between a rock and a hard place. You have to hit these board-mandated sustainability goals, but you're facing extreme capital rationing. Let's quickly define our battleground. Here, CAPEX, or capital expenditure. These are simply the funds a company uses to acquire, upgrade, and maintain its physical assets. Property, equipment, the building itself. When that budget is suddenly tight, and you literally cannot fund a $250,000 chiller and a $50,000 lighting retrofit at the exact same time, how do you actually choose? Relying on a gut feeling or just lazily picking the cheapest project first is a massive error. You need a rigorous system. Moving on to part 2, the practical assessment method, from chaos to clarity. Now, the very first step to prioritizing your backlog isn't actually financial at all. It's operational. Listen, you cannot fund what you don't accurately measure, and this brilliantly illustrates the divide between a facility that gets funding and one that gets rejected. On one side, you have little or no evidence, just relying on vague estimates. You are never getting funding with that. But on the other side, you have the gold standard, key loads metered, tracked, analyzed. When you have excellent data and you know your exact baseline, you can prove to the penny what a new project is actually going to save. To get to that gold standard, you absolutely have to follow this step-by-step sequencing. First off, no guessing. I want you to go grab a minimum of 24 months of your actual utility bills. If you have half-hourly sub-meter data, you need to pull that too. You need to log the exact equipment operating hours and the nameplate capacities right there on site. Next, you benchmark that data against similar facilities. Only after you've done that do you start identifying your efficiency measures. And lastly, and we'll talk about this more in a second, you sequence your renewables. Once you have that pristine operational data, you enter the world of MCDM, which stands for multi-criteria decision-making. This is kind of the ultimate tool for corporate energy engineers. It's basically a scientific framework that lets you evaluate multiple, often totally conflicting criteria to accurately rank your alternatives. It's what allows you to justify decisions way beyond just the immediate dollar cost, right? You're balancing hard financial returns, like your net present value, with those really crucial but sometimes hard to quantify sustainability goals, like reducing pollution. Which brings us perfectly to part 3, 3 key project calculations, the math that matters. So the crucial point is this. While we desperately want to be sustainable and hit those greenhouse gas targets, your CFO only speaks the language of risk and return. To win your CAPEX, these projects have to survive strict financial scrutiny. And that starts with rule number 1, the absolute golden rule. Prioritize efficiency over renewables, every single time. You must reduce the facility load before you green the supply. If you skip this and don't cut your base load power first, you are literally going to end up buying a massively oversized, incredibly expensive solar array just to power a horribly inefficient building. Okay, let's get into the math. Formula number 1 is the profitability index, or PI. PI equals 1 plus your net present value divided by your initial investment. This simply measures the actual value created per unit of investment. Think of it like this. A PI of exactly 1 means you're just breaking even. Anything lower than 1 means the present value of your future cash flows is actually less than your initial investment. So when you're rationing capital, any project with a PI under 1, toss it out immediately. Formula 2 is the savings to investment ratio, or SIR. This is your net present value divided by your total out-of-pocket cost.
But look closely at the denominator here. It's your cost minus rebates, minus other grants, minus non-energy benefits. This right here is exactly where you factor in all those sweet utility incentives. And your second golden decision rule is this. Only, and I mean only, move forward with energy projects that achieve a minimum SIR greater than or equal to 1.01. And finally, Formula 3, IRR, or internal rate of return. You can think of IRR as your break-even discount rate. It's the exact rate at which the net present value of a project hits zero. Now, why does your CFO care so much about this? Because IRR lets them compare the profitability of, say, your chiller upgrade directly against what that exact same chunk of money could earn if it was just sitting in a commercial bank or invested back into the company's core business. Your IRR simply has to beat their opportunity cost. Part 4, avoiding common costly mistakes, planning for reality. Now, I want to pivot to a bit of a cautionary tone here because this is where a lot of projects just completely fall apart. You can have perfect data and flawless formulas, but if you rely on static assumptions in a dynamic facility, it will utterly destroy your ROI. A lot of planners love using a marginal abatement cost curve, or a MAC curve. Basically, it's a graph that ranks greenhouse gas mitigation options from the lowest to the highest cost per unit of reduced carbon. Now, what's really interesting about this is that while they look great on paper, relying solely on static MAC curves is often dangerously flawed. And here is exactly why. Static MAC curves assume you live in a perfect world. They totally ignore the interactions between different sectors and rely on these frozen static assumptions about equipment cost and performance. What you actually need to be doing is dynamic scenario analysis. Scenario analysis tests real-world conditions. I mean, what happens to your payback period if you hit severe construction delays? What if there's a sudden massive fuel price shock? You need to model a base case, an upside case, and a highly realistic downside case. And that feeds perfectly into sensitivity analysis. While scenario analysis looks at those broad, overarching stories, sensitivity analysis is where you tweak your inputs one by one to find the exact breaking point of your project. You're going to stress test things like energy prices, interest rates, inflation, and operating efficiency. By doing this, you aren't just guessing anymore. You are actively proving to the lenders and your CFO exactly how resilient this investment is when things inevitably don't go according to plan. Part 5. Conclusion and field checklist. Look, when CAPEX is tight, you simply cannot afford to guess. Capital rationing demands rigorous math and flawless data. So I want you to take a screenshot of this rapid-fire field checklist right now so you can use it today. Number 1, target baseline efficiency and load reduction before you ever even think about sizing a solar array. Number 2, get off estimates. Go pull 24 months of half-hourly meter data and meticulously check your equipment nameplates. Number 3, calculate your PI and your SIR and ruthlessly discard anything under a 1.01 ratio. And number 4, protect your own credibility by running a downside scenario analysis before you ever walk into that CFO's office. So, as you sit back down and stare at your own backlog of 20 projects, I want you to ask yourself, are your current energy investments truly resilient? Or are they really just a static best-case guess? It is time to do the math, stress test your assumptions, and build an energy portfolio that actually lasts. If you want to dig deeper into the actual nuts and bolts of project finance modeling, definitely check out the exact sources we used to build today's explainer. We're talking the UNFCCC, the AWS K-12 study, the AHP Capital Budgeting Framework by Torrens and Platt, plus fantastic data from the Carbon Trust and Energy Star matrices. Thanks so much for learning with us today. I'll leave you with this one final thought. Are your facility's energy investments resilient enough to survive real-world chaos, or will they just collapse at the first sign of trouble? Think about it. I'll see you in the next explainer.